This is the history of American banking. So banks, they're an institution for receiving, keeping, and lending money. So they receive money from people and businesses, they keep it and hold it for them, and they also lend money to businesses and people to buy things or start a business, add on to their business, build buildings, buy equipment, and stuff like that. Banks were with merchants in the old days, a long time ago. So, like when they had a merchant owned like a clothing store or a food store, something like that, people would leave their money there and they would take care of it. The merchants usually would charge a fee for this, for kind of like, since I'm going to hold it for you and keep an eye on it, then I'm going to charge you a little bit. But sometimes the merchants made bad investments with it. They would lose their money, steal steal the people's money, and things like that. So people sometimes lose their whole life savings on there. So not all the merchants were honest in there, and people lost a lot of money in there. There are two different views of banking. First, there was the Federalists. They were led by Alexander Hamilton. Hamilton was the Secretary of the Treasury of the United States. He believed the country needed a strong central government. He thought there should be one back national bank. He believed it was necessary for a centralized bank to promote industry and trade. So he thought there should just be one bank for the whole United States, and people would use that one so it could be controlled by the United States. The Anti-Federalists, which was led by Thomas Jefferson, he favored leaving most of the power to the states to operate banks. He didn't think there should be a central bank run by the federal government. He thought it should be decentralized and not solely operated by the government. States would establish and regulate all the banks. So the states would do all the regulations, watch the banks, start them, charter them, and make sure that they were running okay, and leave it up to the states instead of the federal government taking control over all of them. The very first bank was the Bank of the United States. The Federalists were successful in creating a strong central bank. The representative money was issued in banknotes. So we talked about the representative money, just a piece of paper, and they called them banknotes, and that's what people use to buy things and loan out and things like that, paid back debts and other things. Money was backed by gold, and the Treasury held government taxes there also. Congress said that the bank could operate for 20 years, so they had a charter for 20 years, and after the 20 years was up, then the bank would no longer be run by the government, the federal government. So after the 20 years, the charter ran out, and the Anti-Federalists won and were able to open state-run banks. And the reason the Anti-Federalists won is because Hamilton was killed by Burr, and so Hamilton was the big backer, the person that was really in favor of one bank, a centralized bank by the government. But since he was no longer alive, then they didn't have anybody to kind of root for him and want to make sure that there was just one bank. So the Anti-Federalists won that, and they gave the authority to all the states to open up banks in each state. State banks issued banknotes, but they could not back up by gold or silver sometimes. They were unstable, were not regulated by anyone, and made prices increase. So they didn't always have the gold and silver that they needed to, so if people came in and said, I want my money in gold and silver, they'd turn in their banknotes. They would not all the state banks would have that gold or silver to turn it in. So some of them ended up closing because of that. Different banks issued different currencies and printed more money than they had in gold and silver to back it up if people decided to turn in their money for gold or silver. Now the part with the different currencies, just think if you had all these different banks and they all issued different kinds of currencies, some of those currencies you wouldn't be able to use in part. So let's say we had a bank in Eldridge and it had currency that they issued, And let's say there was a bank in Long Grove and they issued a different type of currency. Well, if I took my currencies to Long Grove to buy things, I wouldn't be able to use it because they don't accept that currency there, and vice versa in Eldridge and everywhere else in the United States. So that was a problem because not everybody would accept the different types of currencies, so they were not able to use them throughout the United States like we can today. So today we can go, no matter where we go in the United States, our currency is accepted everywhere because it's one type of currency that the government says we are going to use and that is going to be backed by the government, and that is what we're going to use to buy things, pay debts, loan out, and things like that. To help people get back the confidence they used to have in banks, Congress then opened or started the second bank of the United States. And this was just like the first national bank. So the central government, or the government, ran this bank. It was centralized. Nicholas Biddle was the president of the bank. And sometimes he thought banks were not being honest with people by saying that their money was safe and would be backed by gold or silver. So he would surprise banks with notes to get the gold or silver. If the banks could not pay, he would shut them down. So he would take bank notes and go to the bank and say, okay, I want to turn these in for gold or silver, because he wanted to see if they would be able to do that. And if they couldn't, then he would shut them down, because all banks were to have enough gold and silver that if people came in and wanted to turn in their banknotes for gold or silver, that they would be able to do that. And not all banks were doing that. They were printing more money than they had gold and silver for. So people would have this money, but really it wasn't worth anything at all. So the free banking area, sometimes called the Wildcat area, and the reason it's Wildcat area is because some of these banks were way out in nowhere land. Kind of like if you were just like an open field, or way out in like Wyoming or Montana, open. There's nothing else around at all. It's just a bank, and that's about it. State banks flourished during this time at first, and they also tripled. But then there were problems during this area. There were bank runs, meaning people would go in and want all their money out, so the banks sometimes would not have enough money to give all the people that. So that's what bank runs is when people go in there and want all their money out. There's a very high failure rate. A lot of banks collapsed or closed because they didn't have enough gold or silver to give people their money when they wanted to turn it in, or they'd give out bad loans and people weren't able to pay that back. Fraud, the banks would take the money, embezzle it, make bad investments, and once again they had different currencies, which was kind of useless, because if you took it anywhere else besides around that area, you could not use it because it was not the same currency that the banks in that area would use. The National Banking Acts of 1863 and 1864, this gave the federal government power to charter banks and require them to hold adequate gold and silver in reserves. All state currencies were eliminated and had one single national currency, which we have now. So all those currencies from the states that issued their own, like Iowa had their own, Illinois would have their own, Minnesota, whatever, those were all eliminated, and the whole United States had one single national currency. There was a gold standard that specified that paper dollars and coins were worth about $20 in gold. So if you had this paper dollar that you wanted to turn in, the gold standard said it's worth about $20 in there. So there had to be enough gold and silver in reserves, so in case people wanted to turn in those notes and those currencies, that they would be able to get their gold and silver from that. Then there's the Federal Reserve Act, eventually, that came in 1913. The government started the Federal Reserve System. It became the central bank, and that's what we have today. The Federal Reserve System is the central bank of the United States. Now, yes, each state can have banks, and states can charter banks, meaning they can say, yes, you can open up in our state and loan out money, keep people's money for them. but it was able to, increase the money supply. That's what the Federal Reserve System does. They either can supply money by printing more or taking back more or less if they don't have enough, if people aren't spending or they are spending, so they can regulate how much money is out there in the economy. They loan money to banks, so if banks need money to loan to other people, they would loan them some money, and we'll talk about a little bit the loaning money to banks from the Federal Reserve and banks loaning money to banks later on. And they would store cash reserves for banks also, so the banks didn't have to keep all their money in their vaults there. They could keep it at the Federal Reserve, which would be more secure. There's 12 Federal Reserve banks in the United States, so they're all over the United States. There's one in Minneapolis, Chicago, St. Louis, Dallas, San Francisco, Philadelphia. So there's just a few, Denver. So there's a few in there. Now banks have to be a member. Now all banks have to be a member. If a bank is not a member, then they have to go through another bank that is a member if they want to borrow money or have their cash reserves with their Federal Reserve or that bank. So in order for the Federal Reserve, the government, to help them out, banks have to be members of it. The Federal Reserve issued Federal Reserve notes. That's what we have today. If you look on there, it says the Federal Reserve notes. The advantage of having this is that the Federal Reserve can change the amount of money in the circulation to help control business needs or the business cycle. So if people aren't spending money, they might put more money out there to help people to spend more money. Or if there's too much inflation or people are spending way too much, they might take some back so that people aren't spending as much money. They help businesses that way, so businesses don't collapse, don't close down, and they're able to grow and make money if they need to. And the last couple things here, during the Great Depression, which was in 1929 and lasted more than a decade, the unemployment rate was approximately 25%, which is quite high. In the Quad Cities here, it's around 6% right now. So it's kind of high right here, 6.7 or 7%, somewhere around there. There was a lot of bank runs. People wanted their money because they didn't trust the banks, so they wanted to have all their money out of it. Businesses could not pay back loans to banks, so banks were closing down. And then the stock market crashed because people were investing in the stock market. And eventually, since the businesses could not grow anymore or pay back their loans, then people lost jobs, which means people lost money in the stock market because of their investments. So that's how the whole stock market crash and the Great Depression. So there's a lot more detail into that, but that's kind of an overall of basically what happened. Then in the 70s and 80s, there was a savings and loan crisis. So there used to be a savings and loan banks. I think there still are right now. Government used to regulate them, but then they deregulated them. So when they started closing, the savings and loans didn't have the government to help them out. So they would have, they gave out a lot of low interest loans to people, businesses. But then when interest rates started going up, they had to pay more out to people that had their accounts, their savings accounts. So if they're paying more to people with savings account and interest than what they're taking in from loans, that means they're going to be losing money. So that's what happened when the interest rates increased. So then a lot of savings and loans banks failed during that time, and were not able to survive because of the government not able to help them out because they deregulated them. There used to be a savings and loan here in Eldridge. It's where Sips Coffee is. Used to be Winter's Pizza and that Honda car place right across the street from Casey's, and that was one of them that closed there too. So they were savings and loan. They had to go through a bank here in Eldridge to make their deposits. But once again, because the interest rates started going up and they were losing money, they ended up closing. The Federal Deposit Insurance Corporation, FDIC, you'll see this little sign when you go into a bank. And what that means is that if a bank fails, customers won't lose their money, and customers are guaranteed up to $250,000. So every individual account you have is guaranteed, insured up to $250,000. So if a bank closes, fails, and you had your money in there, as long as you didn't have more than $250,000, the insurance corporation will pay you all what was in your account at that time. So banks have to pay into this so that if that does happen, people won't lose their money. And the last thing is subprimes. These are loans that are made to borrowers with unfavorable credit history. So there's prime lending rate and then there's subprime. So people don't have very good credit history. So that's why it's very important to have excellent credit history. And we'll talk about credit history and your credit score and stuff like that later this semester. If you don't have very good credit history, then your interest rates on loans when you borrow money is going to be higher than somebody that has excellent credit history. So that's why it's so important to make sure you pay your loans on time, payments, credit cards on time, stuff like that. Because if you do, your credit score is going to be a lot higher, and then you will be able to get a better credit interest rate. You'd be able to get a better interest rate if you borrow money for a house, a car, or anything like that. Credit cards, interest rate on credit cards. All those things can be a lot lower because they know that your credit is good because you're able to pay things back without being late, or you pay it back when it's completely due and not paying it back at all. So we'll talk a little bit more about this. Make sure you go back over this if you don't if you're not quite sure or understand something. And if you have any questions, let me know and we'll talk about that in class. Thanks.